I'd like to welcome everyone to Advantary's workshop, Optimizing Seed Stage Fundraising, Tips and Tricks for Success by our workshop leader and subject matter expert, Angel Orrantia. He is an Advantary partner, and he is going to be talking about insights into fundraising, M&A, IPO prep, and fractional general counsel, all of which can determine a company's success, especially in today's recession landscape. This session is interactive, so please feel free to raise your hand and ask questions. And I'm going to turn it over to you, Angel.
Great. Thank you very much. Thank you, Betsy. Thank you, everybody, for joining so bright and early on a Wednesday morning. It's great to see you all. Of course, my computer froze. Here we go. So I'd like to start the workshop off, as all good workshop leaders do, with some really scary statistics about what we're about to try and accomplish in this workshop. Probably the most scary statistic isn't actually on this slide, and that is that only about 10% of the companies that attempt to raise VC capital will actually be successful in doing so. So what I aim to do in today's workshop is to give you some tips and insights that we use at Advantary when we're helping our clients with our fundraising campaigns, primarily focused on the seed and pre-seed, but I can also speak to, and I have some materials on raising the Series A and beyond the equity rounds. So if you have any questions on those, feel free to ask those as we go along. And as Betsy mentioned, this is intended to be interactive. So at any point, if you have questions, please don't hesitate to either send a chat message or just jump in line and ask the question out loud. So before we really launch into the materials, as we all know, the VC industry is largely a whisper industry, and the terms, although they're generally accepted, they're sometimes a little bit vague. So just to get started in this conversation, what I wanted to do is just give you some insights as to how I think about the different categories. So pre-seed, I usually think of as companies that are pre-revenue. Seed is usually an early revenue, whereas Series A is usually where you start raising your growth capital. So pre-seed and seed, most of the time you're going to be raising somewhere between $1 and $5 million. The sweet spot is about $2 million today. That round is closing in just over 4 months, kind of approaching 5 months today. Your sources of capital for these rounds are going to be high net worth individuals, colloquially known as angels, angel groups, family offices, and micro-VCs. You'll notice that there's a bit of a gap between the seed stage and the equity stage, right? I kind of stopped the seed stage at $5 million, whereas the Series A starts at $16 million. There's kind of a no man's land between that $5 and $16 million. What I usually recommend to my clients is they break up their raises so that instead of raising one really large, $10 million seed, maybe they do 3 small or $3 million seeds or 2 $5 million seeds to accomplish the same thing. But the equity rounds usually start at Series A. This is where the VCs come in to give you the valuation of your company. And as I indicated, the average Series A today is $16 million with most of the time, the VCs are looking for a $5 million ARR hurdle rate, meaning to get their attention, you're going to need to be making at least $5 million in revenue. Your sources of capital are really just limited to VCs. When you're talking about these valuations, there's very few investors that have the risk, that can accept the risk premium at these valuations. So you're pretty limited to VCs. But recently, what we've started to see is more venture debt players come into the market. So what I usually recommend to a lot of my clients is to build in a debt portion to your equity rounds. A lot of investment banks and private lenders will lend up to 30% of your equity raise as long as you're using a reputable VC to do the valuation. So that's a good way to save quite a bit of dilution. And obviously, while venture debt is not the cheapest form of capital out there, it's a lot cheaper than equity. So just real quick, I've only got one slide on raising equity. Fundamentally, there's just one way that I know about going to raise an equity round. It's a time-tested methodology. You basically start with recent exits that are similar to the company that you're trying to raise money for and work backwards. If you're raising a Series A, go back to who their Series A investors were, and they just had an exit. So, we know they're flush with capital and they should be pretty happy because they just had an exit. So what better time to offer them a new opportunity to invest in the same space, hopefully with better results this time around. The other thing you'll need to do is jump on Google and just do a lot of searches and find out who is deploying capital in your space. The VC industry is actually relatively small, and it's very stratified. So what you want to do is find out who the investors are in, at the stage that you're raising for, and that are investing in your space, and make a list of those people. What you want to end up with is a list of 10 to 20 investors that you want to start reaching out to. But with VCs, as most of you know, you can't just send in your pitch deck and expect to hear back. The best way to approach a VC is to get a warm introduction. And the best way to get a warm introduction is to exercise your own network and find people that can give you that introduction to the VC that you want to make contact with. Once you make contact with them, the methodology that we're about to discuss on the seed stage fundraising will kind of kick in. Are there any questions at this stage that I can answer for anybody?
On the previous slide, you had expect to do 200 messages requesting invites, and here you have a list of 10 to 20. I'm just wondering about that delta.
Sure. So we're talking about two different fundraisers, right? If you're going to reach out to angel investors, you need to make contact with, for every $100,000 of capital you want to raise, you need to reach out to 100 investors. So if you're raising a $2 million round, that's going to be like 2,000 investors. I think the stat you saw here, is this the one you're talking about?
Yeah, the 200 meetings. With investors matching target profile.
Right. So that would be for seed stage and pre-seed fundraising campaigns.
Got it. So specifically just angel checks, not the VC leads. Right.
And so that's actually a really important distinction, right? So and you kind of jumped ahead of me one slide, right? So in the no problem at all. So when you're raising a pre-seed and a seed stage, the methodology is completely different. And this speaks to the question you were just asking. When you're talking about these stages, it's a pure numbers game, right? You're not going to get warm introductions to the, if you're raising the $2 million round, to 2,000 investors out of your network, right? Some of this is going to, by necessity, be cold call, although I do encourage you to definitely use your network to make those preliminary introductions for you. The other thing I would recommend to everybody is use a CRM, and the key, probably more so than in the equity rounds for the pre-seed and seed, is to continue to follow up with investors. Be persistent, but not annoying. So as you start to get ready to go fundraising, make sure that you have a very clear message and that your value proposition is as obvious as you possibly can make it. If you ever walk out of a meeting thinking the investor didn't get it, then make sure you look in the mirror, because the only reason the investor didn't get it is because you didn't explain it properly. So always make sure that if you're not connecting with your investors, that you really look at the messaging that you're using and the story arc in the deck to make sure you're connecting with your investors. Another tip is to make sure that you have a very polished pitch deck. And by polished, I don't mean you have to go spend thousands of dollars on a graphic artist to make it look completely whiz-bang. Just make sure that it's clean, it's concise, it's brief, right? No, ideally 10 slides, no more than 15. And more than anything, just make sure that you don't have any spelling errors, that you don't have any grammar errors, that it looks like and feels like a professionally put together presentation for your investors. Make sure that you have a concise executive summary, right? If your business is so complex that you can't get it down to one page, it's going to be really challenging for you to get funded. Ideally, what you would want to do is practice getting your company down to a 3-sentence or maybe even a 1-sentence elevator pitch. So one thing I found is that by taking the pitch deck and condensing it down to an executive summary, it actually makes summarizing the pitch deck, if I'm struggling with too many words or too much verbiage in my pitch deck, by creating the executive summary and really forcing myself to condense down the verbiage, it can really impact the quality of the pitch deck if you feed that information back into it. Another area that I see early stage companies struggle with is the data room. Make sure that your data room is completely populated and fully indexed. And I'll get into that a little bit more as we go along. In your data room, the only thing that I'm going to speak to, you all probably have your checklists as to what should go into a data room, but make sure you have a spend plan that corresponds to the milestones that you have in your fundraising deck. So if you're saying that you're going to have a 2-year runway, then make sure that your spend plan goes out at least 2 years. Within the spend plan, you'll want to capture, your revenue, your fundraising targets, hiring, go-to-market strategy, like how much you're going to spend on that, where you're going to spend the money, and then any product development strategies and milestones that you expect to hit while you're in that phase of development. So generally, I counsel my clients to make sure that their cap table is very clean. At this stage, pre-seed and seed, it's incredibly easy to have a clean cap table, but one caution that I will give everyone to protect yourself against future down rounds is definitely do a pro forma as converted cap table, especially if you plan on doing multiple seed rounds. Because you need to understand how much dilution you're going to experience at that Series A or beyond. So just make sure that you keep your cap table clean and take the time to do that exercise. Another thing that I found to be very useful, which is kind of surprising because I personally don't follow a lot of the newsletters and updates that I get in email, but I have found that they are very important for, especially at this stage of development. As you're raising your pre-seed and seed stage rounds, one of the things you'll notice is investors will consistently tell you, I'm not interested in this round, please come back at the next round. Well, one way to make sure that those investors stay, that you stay top of mind with those investors that want to take a look at you later is to go with, I'm sorry. Oh, sure, Adam. I'll answer that in just a sec. Is to consistently send them a newsletter or send them an update. And these don't have to be completely professionally done. Again, you don't need a graphic artist to do your update. It could be as simple as, once a month. Just do it consistently. Once a month, once a quarter. Send people an update. Here's what we accomplished. Here's what we're doing. Here's what we have planned. Very simple. It could be as easy as a 3-paragraph email. Sure. So Adam is asking if I have any recommendations between a priced round at seed and a safe. Yeah, so getting a priced round at seed is incredibly challenging, right? You can price it yourself. I have found those kinds of rounds incredibly challenging to get funded. And then getting a VC to come in and price a seed round is also very challenging, primarily because you don't have any historical financials to base the valuation on. So whatever the VC does is going to be hyper speculation. Very few VCs are actually willing to do that or take the time to do that. So most of the time, if you're below $5 million of ARR, or in other words, unless you're in significant revenues, you're pretty much going to be at the stage where you're going to have to raise on some sort of convertible instrument, whether you want to use the SAFE or a traditional convertible note, kind of up to you and your investors. But usually, unfortunately, you don't really have the option at the early stages, certainly when you're pre-revenue or very early revenue, of doing a priced round. So you're pretty much stuck going with the angel groups, which means that you're going to be doing some sort of convertible debt.
Thank you. And again, sorry, I don't know if I should interrupt or let you continue. Go ahead. The question on my mind, because it's most of what you're saying is verified and consistent with the things that I've seen, and so I just wanted to say thank you for putting it together so pithily here. But the question on my mind is, like I've been told by my advisors, go get $1 million, micro VC, I guess, to lead the seed round. Even if you're raising two, go get someone to put $1 million or $1.5 million in there. And then they set a cap on the SAFE or the convertible instrument. And that cap kind of represents effectively the price. Whereas you had 20% discount there. And I'm just trying to balance the, all angels at 20 to 100K versus have a lead on a capped SAFE.
Yeah. So again, when you talk about lead, usually that's talking about an equity round, because the lead comes in and they set all the terms. Particularly if you're talking about a SAFE note, those are individually negotiated instruments. You don't need somebody to come in and set the terms on a SAFE. Well, actually, it doesn't actually make a whole lot of sense to have somebody else come in and set those terms, because you're negotiating the SAFE note or the convertible note individually with each investor. Now, if you can get a micro VC to come in and give you a SAFE note for $1.5 million, and let's say they do a 20%, or maybe they even do a 15% discount on that, and then they set the valuation cap for you, it's not unusual for other investors to just piggyback on what they're doing. But technically speaking, that's not a lead, right? A lead would come in and give you a term sheet, and then all the other investors would have to sign up to that one term sheet. And notes are the exact opposite of that. Each note is individually negotiated.
Gotcha. Okay. Thank you.
Don't you know why I'm not going to the next slide? Okay. So this is just a summary of the fundraising process. Fundamentally, what you want to do is stuff the top of your funnel with high quality leads to qualified investors, so that out of the bottom of the funnel, you have more investors that want to meet with you than you have time to meet with, and you end up with a genuine fear of missing out. Now, in complete transparency, FOMO is incredibly hard to actually achieve, but if that's the goal, even if you fall a little bit short, it'll still help you close your round much faster than if you were going about it kind of lackadaisically. So just in summary, the first thing you're going to do is develop a list of target investors. Then you're going to need to get their contact information, reach out to them, make sure you're tracking all of your outreach in a CRM, pitch those investors, make sure that you have your properly indexed data room that you can send them to after your pitch, and then follow up until you close each one of the investors. So how do we develop a list of target investors, right? So what I usually do is I start with 3 main buckets. They need to have made an investment in the last 24 months. They need to have invested in a similar company or within the same market segment. And they need to have had a recent positive event in that investment, if at all possible. That last bullet point can be a little bit challenging to actually hit or to find out, but if you scour some news sources, sometimes you can kind of get that information out, and that can really make the outreach to that particular investor significantly more impactful. And, just some other scary stats there at the bottom.
Angel, can you give us some examples of positive events?
Sure. So let's say that one of their portfolio companies just signed a big contract. I had this happen recently. Portfolio company signed a big contract with the government, and they were basically going from stealth to like $50 million a year in revenue. So when I contacted their investors, I was like, "Hey, I just saw that your investment in such and such just went gangbusters. I've got another company that's kind of in the same space. Do you want to take a look at it?" Okay, so obtaining investor contact information. Again, because we're talking about a numbers game here, but you still want to start with your personal network, right? So definitely try and get warm intros to as many qualified investors as you can. The likelihood is you're still going to need funding beyond that initial network that you have. So for that, what I would recommend is use online databases and resources. One channel that I used to use quite a bit before we started using our AI system is Link SV, or Link Silicon Valley. And you can find, companies that are similar to yours in there, and you can see who the investors or who the seed stage investors were for those companies. Now, the challenge with that is that they don't give you their contact information. So you will have to go out and cross-reference numerous other sites to actually find their contact information to get a hold of them. But at least you know that they are investors and they invest in companies that are similar to yours. But the key when you're fundraising is really just to get in front of as many investors as possible. So to do that, leverage as many pitching opportunities as you possibly can, right? And I've listed a few here, but there's competitions, there's opportunities where some accelerators and incubators will just give you the opportunity to just practice pitching, and they will give you feedback. If you're early in your fundraising process, take advantage of those opportunities. There's nothing like getting in front of a live group of investors and having to pitch yourself and then hear how ugly your baby is directly from people in front of an audience. So the sooner you can start having those experiences, the better you're going to get at them. When you do start your cold calling process, I would recommend starting with a small pool. I've seen a lot of entrepreneurs make the mistake of assembling a huge list of all the investors that they want to contact, and they just send out a mass mailing, of 1,000, 2,000 emails to people. And what ends up happening is if there's any kind of mistake, if there's anything wrong with the messaging that you're sending to those investors, you're just not going to get the kind of results that you want. So what I recommend is break those contact lists into smaller pools and reach out to 50 a week the first week, reach out to 100 a week the next week, and just keep incrementally increasing who you're reaching out to. As you're talking to investors, feed that information back into your deck, continue to improve your deck. And at some point, you'll get to the point where your deck is pretty stable, and your messaging, meaning the messaging that you're using to get the deck in front of investors, will also start to stabilize. When you get to that stage, that's when you can really start reaching out to, hundreds or maybe thousands of investors on a weekly basis without, jeopardizing your fundraising campaign. And as I mentioned earlier, track your investor contacts, right? There's free CRMs out there that you can use. You can use Excel as just a very simple CRM, but whatever you do, just make sure that you're tracking all of your responses. As I mentioned earlier, part of what you're going to hear as you're fundraising is, I can't invest in this round, or I'm not interested in this round, but keep me in mind for your next one. Well, the only way you're going to be able to remind yourself to reach out to them at the next round is to track your responses. So make sure that you're putting everything into a CRM. And as Nathan indicated, HubSpot has a freemium model. I think Zoho does as well. And then obviously, Excel will work in a pinch. Just make sure that as long as you're tracking your stuff and you're able to notify yourself or flag yourself when it's time to approach those other investors. Not really part of the CRM, but because you can use the CRMs to send out newsletters, I've included it here. I just want to reiterate that we have found that having a monthly or quarterly newsletter that we send out to investors really help. It's not one of those things that's an instant success, but over time, having that newsletter go out to investors definitely pays a dividend. And anytime you get a request from an investor for more information, follow up as quickly as you possibly can. Don't let that message linger for more than 24 hours. Now, after your pitch, when you give investors access to your data room, make sure that you provide an index in the data room, right? Let them know all files that are in there, maybe a brief description, right? Because the file name might make sense to you, but for an investor, it might not be obvious. So in the index, if you can give the file name and then maybe a brief description of what that file is, that's ideal. Also, make note of any data or documents that aren't in your data room. I can't tell you how many times I've tried to do diligence on a company and I've spent hours looking through their data room, looking for something that wasn't there. And then when I reached out to the company, they just tell me, oh, well, we haven't done that yet, or we haven't gotten to it. So we're going to do that a little bit later. So what I would recommend is make sure that you provide that information up front, save them that time, save yourself from irritating your investors. Obviously, your data room needs to be accessible online, but the other thing that I want to caution you is make sure that you limit the time that you give investors access to your data room. On Dropbox and Google and Box, you can always limit how long somebody can look at your thing. So I would recommend limiting it to 6 months. If you want to be real aggressive, 3 months. But don't make it a couple of weeks, because while you're still in diligence with that investor, they may come back to the diligence room several times. But you don't want to have the security liability of leaving it open in perpetuity either. All right, let's talk about some tips for the pitch. So number one, be bold and confident, but don't oversell. Those are probably the two biggest keys that I can give you. Another issue that I've seen crop up with pre-seed and seed stage companies is that the founder sometimes may not be the CEO, may actually start the company knowing that she doesn't want to be the CEO. And that's okay. But whoever the CEO is still the person that needs to do the pitch. Investors do not like it when you substitute somebody else in for the CEO as the pitch person. Also remember that seed stage investors are prioritizing the capabilities of the team above all else, right? And this is because ordinarily what happens is there's an industry problem that multiple groups are trying to solve. And each of them has kind of their own flavor on how they're going to solve it. But the real distinction between them is the team itself. So that's really what the investors are kind of making their decision on is this team going to be the one that wins in this space? And VCs are only trying to pick the winner, right? They're not interested in picking the also rans. So if they're only looking to place one bet, you need to make your team look as polished and as capable as possible. It is going to be the determining factor for your investors. If the CEO, just looping back to my point earlier, if the CEO is actually intending to transition out at some point, that's okay. In fact, most investors will see right through that, right? If you're pitching to investors that are pretty seasoned and you're not a CEO type, whatever that actually means to you, it's pretty obvious to a lot of people that have been doing this for a while. So what you probably want to do is just get in front of it and make it clear that you're, a technical founder, you're here to help get the company started, but as soon as you can, you're going to bring in somebody that has, I don't know, the business or the acumen that you're the gap that you have in your team. And similarly, if there's other gaps on your team, right? As a seasoned investor, if I understand a business model and I look at the team, it becomes pretty apparent pretty quickly what gaps that team is going to have on their, what gaps that team has, especially for the phase of development that they're in at the present time. So again, the best thing you can do is get out in front of it and let investors know, particularly if you've already identified people that can come in and fill those gaps, which often happens with startups, right? You start a company and you identify some people that want to join you, but they've got day jobs and they can't join your startup until you have funding. That's okay, right? They're not working with your company now. Technically it is a gap on your team, but if you can show people that you've already identified the exact resource that's going to fill that gap, it'll go a long way to reducing the angst that causes in some investors. And probably one of the most important things to remember about the pitch is that the only purpose of the pitch is to start diligence, right? Just like a resume in the career cycle is just to get you the interview and no more. The pitch is just to get you to the point where they want to know more about your company. And that's it, right? You don't have to fit every last little detail or feature about your product or your company into your pitch deck. It needs to speak at a high level about the opportunity that you're presenting to each one of the investors. If pitching doesn't come naturally to you, there's a very simple solution to that, and that is to practice. Again, as reverting back to something I said earlier, get in front of as many investors as you possibly can. Okay, so closing investors. Probably the best thing you can do to accelerate an investor's decision to invest is to support their decision-making process. And as many of you probably know, high net worth individuals can have some pretty unique decision-making processes. So depending on how much time you have in your fundraising process, if each investor is coming to you is near and dear, then you may need to provide a little bit more support to each investor. If you're actually operating in FOMO, then maybe you don't have to support the investor's decision. You can just give them the information. So kind of play that a little bit by ear. But what I would recommend is to err on the side of doing as much as you can to help that investor come to the right decision to invest in your company. If you don't already have sales experience, I highly recommend that you learn about objection handling. There's tons of self-help books. There's tons of videos on YouTube. And if you ever want, I'm more than happy to give you some specific tools and techniques that I've used for objection handling. Again, going back to the idea that only the CEO should be pitching, no one can sell the idea better than the person that came up with it, right? The passion, tenacity, and grit should be obvious when you're pitching. It should basically jump off of the screen at the investors. And then one just caution that I will give you is that no one funds ideas, right? I hear this frequently, usually from first-time founders, where they're concerned that they're going to go leak their idea to the wrong person, that other person's going to take their idea and go become a billionaire and leave them with nothing. One, if somebody else can come in and take your idea and run that much faster than you can, they were probably going to catch you anyway. So even if you kept it a secret, they were going to catch you. So I wouldn't worry too much about telling people your idea. Investors are looking at funding doers, right? They're not the doers. Investors want to invest in the people that are going to go implement the idea, and that's what they fund. So shout your idea from the mountaintops, right? That's the best way to get funding. Let people know what you're doing. Let them know that you're the best team for this particular challenge, and encourage them to support your ambitions. But do not be shy about this, right? Obviously, you don't want to go tell your competitors all your secret sauce about what you intend to do to disrupt their business. But what I'm saying is that at a high level, you should not shy away from telling people exactly what you're trying to do with your company. And ultimately, what you're trying to do is convince the investors that your team is going to be the winning team, period, right? And the likelihood is that they will see multiple teams all trying to accomplish the same end result, right? Solving the same problem, What you want to do is convince them that you're the right team that's going to win that category. So just in summary, Advantary has an investor introductory service focused on pre-seed and seed stage fundraising. We use an AI that was developed here at Stanford University. It creates a 2,000 point psychographic profile of your ideal investor. We then use that profile to search for investors on LinkedIn. We have our own proprietary database of over 1,600 angel groups, out of which we usually find between 200 and 300 groups that our clients would qualify for, that we submit applications. And then we also use the AI in PitchBook. The difference between using it in LinkedIn and PitchBook is that in LinkedIn, investors rarely self-identify. So it's hard to find angel investors on LinkedIn. So what the AI does in that case is it'll go out and check their slime trail. So it'll check things like Facebook, Twitter, Instagram for other postings that validate that not only is this person an investor, but they invest in your space. And from that point forward, it's a traditional email campaign. In PitchBook, we know these people are investors. In fact, we know their entire investment history. But what the AI allows us to do is to rank order those investors from the most likely to invest first, so that we reach out to the most probable targets at the beginning of the campaign and then work our way down. Our pricing starts at $2,500 a month, and there's no monthly minimum. So with that, I will open it up to questions.
Angel, Adam had a pretty good question in the chat. I'm not sure if you saw it.
Oh, did I miss Adam's question in chat?
At 8:33.
Sure. Both pitching. Okay, so Adam is asking, I am one of two co-founders. We are both pitching. Should we call ourselves co-CEOs or can we just be co-founders at the pre-seed seed stage? You can just be co-founders. That's not an issue. And quite honestly, you can use the term co-founder or just founder. I've seen numerous, especially founders, right? Especially when there's just a pair of founders, two founders, they'll just take the founder title, and they won't call themselves co-founders. They just call themselves the founder. Co-founder, when I see three or more, it's pretty rare that they call themselves just founders. At that point, they call themselves co-founders. But really, it's not, whether you're calling yourself the CEO or the co-founder at the seed and pre-seed stage isn't a huge deal. You usually don't get to the point where you're hiring CEOs until you're like at the Series A. So it's almost assumed that if you're raising a pre-seed or seed stage round, that you are the founder. Almost assumed. Not 100%, but pretty close. Anyone else?
Okay. Thank you so much, Angel. That was a really, really informative presentation. And I'd like to thank all the attendees who came today. We will be making the recording available, and so we will update everyone who's attended today when that is, so you can go back and reference the information. And as always, if you have any questions, Angel's contact information is here on the page. Please feel free to reach out anytime. Thank you very much, everyone. Have a great day.